And I want to welcome everybody to the Xrp Unplugged Podcast. This particular episode is going to be very, very fascinating. It takes a little bit of a diversion from all of our total focus on cryptocurrency, or XRP, or when's it going to moon, or all the other good stuff that we laugh about and talk about in all of our XRP community and the XRP Army. And by the way, XRP Unplugged is a part of the XRP Army News.com. So you will find actually this particular episode on the XRP Army News.com, as well as on our iTunes and Stitcher and so forth, which will be noted in the XRP Army News in the next several weeks. So that being said, today's guest is Gary Gammon.
Oh, George.
And Gary is an educator. He's an entrepreneur. He's an investor. And he's also, with his tremendous YouTube channel, which we became familiar with him on, and in which we have learned a tremendous amount. And today, I want to ask Bob some questions that I hope he'll help me clarify in my own mind, as a matter of fact. So welcome, Bob. Appreciate you coming to the episode of XRP Unplugged.
All right, no problem. So George, you can call me anything you want, but most people call me George.
What do I call you? Gary? What do I call you? George?
Yeah.
Anyway.
George. Yeah, anyway.
George, okay. All right. I'm sorry about that.
No problem.
I think a friend by the name of Gary, so that's my fault.
No
All right,
problem.
so that's only my first mistake today, and I'll make a few others, but it's not good to get somebody's name right. Sorry about that, George. All right.
No problem, buddy.
As we move forward here, I mentioned that you are an educator, you're an entrepreneur, you're retired right now, but I also know that you travel and your investments are in various places in the world. Where am I talking to you from, matter of fact?
Right now I'm in Medellin. I'm in Medellin, Colombia.
Okay, all right. Now that just reminds me of cocaine and things. So what is that? Is that you're not there for those purposes, I realize, but sorry about that.
Yeah, it's a great place. If you've never been here, or if any of the listeners, next vacation they have, I'd strongly suggest at least researching it. It's Medellin. They call it the Valley of Eternal Spring. The reason they do that is because it's at this unique place on the globe where the weather literally never changes. It's the exact same every single day. And that's, I really like warm weather. And so it's about 80 degrees during the day. It's about 65 at night. So if you like that type of weather, it's jungle, there's parrots everywhere. They've got great golf courses, great food, great people. And you're a 3.5 hour flight from Miami. So what's not to like? That's why I choose to spend quite a bit of time here. And the margins, or the return that I get on my real estate investments are a lot higher than I can get in the U.S. So it's
and that's what took you down there, isn't it? Is your real estate investments and spreading your portfolio around the world a little bit.
Yeah, initially it was oil. Initially it was oil. So back in 2015, if everyone remembers, oil got down, I believe, below 30 a barrel. And so I thought to myself, all right, well, I'm a long-term investor, and that's not really an investment because it doesn't pay me to own it, but it is a good speculation. So how do I go long oil? I was in Ecuador, or maybe Puerto Rico at the time, and I thought, well, the peso is kind of tied to oil. So I thought, let's go to Colombia, check it out. I came to Medellin, and I thought to myself, well, I don't really know anything about oil. I don't know how to go long the commodity, but I want to get involved with the currency. That's one way I could go long the commodity. And it's cheap right now because of oil being down below 30. And I thought, well, I know a lot about real estate, so that will be a good way to express the bet. And I'll just buy real estate that's denominated in pesos. It's tied to oil. And if I can go in, get a cheap property, then remodel it, then I can have some built-in equity, or forced appreciation is what they call it. And if I can make a pop on the currency because oil goes back up to 60 or 70 a barrel, then it's a double whammy. And if it doesn't, if it goes against me, then I've got a hedge in the equity that I built in the real estate project.
And as you went along, I understand you also had a television show
Yeah.
about housing and kind of I think, modeling kind of show. Tell me a little bit about that. What happened with that?
Yeah, it was just the exact same type of TV show that you see in the United States. It's really popular, and it was at the beginning of the year, and we were doing all of these remodel projects down here, where we buy these ugly houses or apartments, and we fix them up, and then we resell them. It's exactly like the shows that you see in the States, but we were doing that in real life. So I went to the local TV station and I pitched them on doing the show, and they said, "Well, if you want to produce it yourself, fine, we'll put it on air. We'd love to put it on air." So they put it on prime time, 8 o'clock Sunday nights. And we did a season of that. And at the end, I really enjoyed doing the show. It was fantastic. It was really popular. But at the end, I just didn't really like dealing with the network too much. So I had all these great editors and camera people. So that's why we started the YouTube channel.
And they seem to be doing a great job, because I noticed on the last several I watched, you were up around 75,000 views, and I think around 35,000 as far as your subscriptions. So you're not doing too bad, my man. I really enjoyable channel, to say the least. You know, we're in a very period, I think, in our world economic system. 2020 is going to be a fascinating year to watch, but you have some fascinating things that you have said along about what's happened in the past. In other words, could you give us kind of a timeline, so to speak, of why we are in this particular spot in 2020, and where it started, and why it's kind of rolled along like it has over the last 40 years, 50 years? Can you do kind of a timeline series for me?
Boy, that is a great question. Boy, I mean, you'd really have to go back. Boy, you could go all the way back. You'd really have to go back to 1913 when they started the Fed and the income tax. But taking it to a little more modern history, I think you'd have to look at 1971 when we went off the gold standard. Because once we created this fiat money system, which means that nothing is backing it, you can just create limitless amounts. If you look at the money supply, not only what happened to inflation, but if you look at what happened to asset prices, debt, from then to now, it's hockey stick type growth. So it has to, if you think about what the Fed does with increasing their balance sheet or quantitative easing, which essentially is creating more currency units out of thin air, that's not possible if we're on a gold standard, because you can't print any more gold. So the money supply is limited. Now, of course, I know that in times of war and certain situations that they've gone off that. But if we're strictly to adhere to a gold standard, then, or any type of standard where there was a limited supply of money, I mean, you could throw Bitcoin in there as well. Correct me if I'm wrong, but there's 21 million Bitcoin, so that would limit the supply. But now we're on a system where there is no limit to the supply of currency units that the central banks can print up out of thin air. And what that does is it brings out the worst in human nature, not only from a standpoint of consumption as in the general public, but also from the central bankers, because it gives them this power that they didn't have before. And they start to think that they're a lot, I don't want to say perfect, but they start to think that they are so intelligent that they can predict and control things in our economy. And if they didn't have that power, they never would have been put into that position in the first place. It's like that saying that what is it, that power corrupts and absolute power corrupts absolutely, something to that effect.
Yes.
And so that wouldn't be possible if it wasn't for 1971. And then what happens is, so what's the downside to that? Well, the downside to that is that you get people in control, like Alan Greenspan, who thinks that he can smooth out the business cycle by lowering interest rates. And all of a sudden, we've gone into this new age where recessions don't have to exist. And the up and down of the business cycle, as it's defined by the Austrian school, we don't have to do that. We don't have to go through that pain. All we have to do is drop interest rates down, increase animal spirits, as Keynes referred to kind of the entrepreneurial spirit. And we could just smooth out this cycle because the government could spend money. They could drop interest rates, increase the amount of loans in the real economy, and that increases demand. The more demand that's out there, people start to feel better. They start to spend more money, and then that brings us up out of the recession, and then we're off to the races again. That's theoretically the way it's supposed to work. But as we know now, that's not the way it works. What it does is it creates asset bubbles. And if you go back pretty much starting at 1990, the bubbles just get bigger and bigger and bigger and bigger and bigger. And they have to do more and more and more to smooth them out. It's very much like an alcoholic or someone who's addicted to drugs, in the sense that they need more and more of these drugs to maintain a certain high, if you want to call it that. And so that's where our economy is now. We're in this, Peter Schiff calls it a bubble economy. And I think that's a great way to look at it. With, stocks are at an all-time high. Bonds are at basically a 5,000 year high when you look at the interest rates. Corporate debt, all-time high. Mortgage loans, all-time high. Consumer debt, all-time high. State debt at an all-time high. You've got, was it $13 trillion right now in negative yielding sovereign debt and corporate debt now? And that just could not happen if it wasn't for 1971. So that's kind of a right off the top of my head, a brief little timeline there.
Very good. But then you bring into question, all bubbles must burst.
Yeah.
And since all of them are a bubble, as you just outlined right there, which is the first one that's going to start the domino effect here?
I think we could have multiple, because I just did an interview yesterday with my good buddy. We're posting it today. His name is Eric Townsend. He's with the Macro Voices podcast. He's the host of that. And we were talking about how before, let's call it 10 years ago, if you were to go to any financial planner or even a lot of big money managers, they'd say that the way you diversify, the way the average Joe should diversify their portfolio, is they should have let's call it a 60% allocation to bonds, treasuries, and then a 40% allocation to stocks, or vice versa, depending on your age, something like that. And the mentality was, well, if you lose money in your stocks, you'll make money in your bonds, and it'll just even out. And this is the safe approach to investing for all of the orphans and the widows and just the average Joes that cannot afford to lose a penny, because this is what they need for their retirement. Well, what we've had since the great financial crisis, and when the Fed comes in and starts quantitative easing, which basically just injects money into the financial system, is you have stocks and bonds going up at the same time, as far as going up in price. And everyone loves that. Oh, this is fantastic. Everyone's making money. Everyone's enjoying, the punch bowl is out and everybody is participating. The party is going. The problem is they don't think about the fact that, wait a minute, this thing that we thought was true, meaning that there's kind of almost an inverse relationship between stocks and bonds, that's not true, because they've gone up. They've both gone up simultaneously. It's just now people like to just kind of ignore that because everyone's making money. But what that means is that stocks and bonds, if they can go up at the same time, they can go down at the same time. And now our economy has been so financialized And what I mean by that is, if you think about the way a stock market should work, it's comprised of businesses that make profit from the real economy. So their share price should be predicated upon how much profit they make, or the real economy. But that's not how it works anymore, because the stocks of these companies have been going up and up and up and up and up, not based on fundamentals or how much money they make or how much profit they make. It's because of excess liquidity, or let me say that in another way. It's because of all these currency units that the Fed has printed out of nowhere. That's gone into the stock market. That's what's raised the prices. It's phony money. It's monopoly money. That's why the stock market is at all-time highs. And when you combine that with these artificially low interest rates, that makes these huge investment funds, and I'm talking about the pension funds right now, go further and further and further out the risk curve, then that exacerbates the problem, because these pension funds don't know where to get a 7% yield. That's what they have to get to meet their liabilities. To all the teachers and the police officers and the firefighters, they have to have a 7% return. So if the Fed drops interest rates down to, let's say, 0 for 10 years, and that means treasuries come down to, let's call it 2-3%, well, all of a sudden, that pension fund is screwed. They can't meet their life. So what that means, they have to make riskier investments. They have to start investing in Uber. They have to start investing in SoftBank, in WeWork, and several others. I mean, you could go on down the line, but that just gives you an example of the investments that these pension funds are forced to make because of the Fed's artificially low interest rates. So how does that apply to what I'm saying? So then these pension funds buy corporate debt, because that's the only place that they can actually get a yield. And by the way, they're buying that corporate debt with leverage. They're buying it on leverage. And then the corporations take that money, and what do? They go right back into the stock market and they buy their own shares back. And they do this because they know there's a Fed put. And so, just in case, I want to be clear for your listeners who might not know what I'm talking about. The Fed put is just a market term, meaning that the Fed has the markets back. If the market goes down by more than X%, the Fed is going to come in, they're going to start another round of quantitative easing, and you don't have to worry about it. Basically, the Fed is backstopping the market. So all these professionals see this, and money managers or corporations, and they're like, why on earth should I invest this $1 billion on new factories and creating more jobs? And there's so much more regulation out there. That's a huge risk. Why would I do that when I could just buy my own shares back? And we know the Fed has our back. They're not going to let the stock market go down. And we can just make money on financial engineering as opposed to actually creating stuff, which makes the real economy better. So my point is our entire economy, let me make a differentiation here. We've got the real economy and we have the financial economy. The real economy has been so consumed by the financial economy. It's completely perverse, to the point where now, if the stock market goes down, the real economy goes down. Now they're completely combined, and there's no getting away from that. Where before, you go back to, a country like Colombia, okay? If the stock market went down in Colombia by 40%, what would happen? 0. Nothing. No one would care, because no one owns stocks. No one really cares about it. Now, that would probably indicate that the economy wasn't doing well. But it's in the United States, if the stock market goes down by 40%, what happens to the economy? The economy is toast. So when you ask your original question about, what's the first shoe to drop, I think it's that we have a recession in the United States, and that triggers asset deflation. And that asset deflation triggers an even worse recession that moves us into a depression. And then it's a question, And when I mean depression, I'm just talking about negative GDP growth. And then it becomes a question of, okay, well, what does the Fed do? So that's where you get this tug of war between the Harry Dents and the Peter Schiffs, where is the Fed going to be able to print enough money or currency units? And are they actually going to be able to get that into the real economy with velocity to increase the inflate or to create the inflation that they need to continue to prop up that bubble? Or is is all the debt in the system just going to clean itself out and have this big asset deflation and that's kind of the Harry Dent side of it. So I know, again, that's a long-winded answer, but you get me talking on this stuff, darn it. And I just go off on a tangent. I can't help myself.
I hate it. For sure. But I don't know, but it seems to me like the U.S. economy is certainly tied to the world economy or vice versa. But we seem to be kind of in an interesting position right now. For example, Germany, they're at 0% as far as
might
interest.
Be negative.
And we're going down. I think we did we raise a quarter? Or we drop a quarter last time. I can't remember, but I do know that the president is pushing for 1% or 0%.
Oh, he wants negative.
Well, that's right. He wants negative. You're right. But once we get that point, how in the world do you ever bring interest back up again?
You don't.
Because it's just going to stay there, isn't it?
Yeah. You don't. And so this is one thing that we touched on, we meaning Eric and myself, that, and this is some fabulous insight that I didn't know about. He said that before Volcker passed a few weeks ago, he said that there would be no way, he said it would literally be impossible for the Federal Reserve to fight inflation the way he did in 1980 and 81, meaning jack interest rates almost to 20%. Most people forget that. Volcker took interest rates above 19% Fed funds. And so that crushed the economy. But his point was Powell or whomever comes next, they're not going to have that opportunity. That tool is out of their bag. Why? Because back in 1980, the debt to GDP ratio was peanuts. I mean, I don't know right off the top of my head, but I would guess the debt to GDP ratio back then was 20, maybe 30%. Just nothing compared to what we have today. And not only that, consumer debt was a fraction of what it is today. The state
savings was way up.
Right. So if you look at all of this debt in our system that has to roll over, right? The government doesn't have a 30-year fixed rate mortgage on their 23 trillion in debt. That rolls over. And it's getting shorter and shorter and shorter as far as that time frame that it has to roll over. In fact, I did a video the other day where Luke Groman pointed out that just last year the Treasury or the government had to roll over 11 trillion in debt. And so for the next 6 months, he did the calculation, and the government is going to have to roll over 6 to 7 trillion in debt just over the next 6 months. So that begs the question, okay, how does that work out when when interest rates start to normalize, whether it's because the Fed wants them to, or because the market decides, okay, we've had enough of the shenanigans. Now it's time for us to take control of the yield curve. And I don't even want to go down another rabbit hole, but you look at the yield curve and the Fed thinks that they have control of the short end, but look at the repo market. The repo market shows that the Fed might not even have control over the short end of the yield curve. So if they lose the short end and they lose the long end of the curve, then you see interest rates go to the moon, and all of this debt that we have in the system that has to adjust, that they just cannot do it. So then what happens? So then you have the release valve, if you will, is just like it was in the 1970s and before Volcker jacked rates. The release valve is the dollar. That's it. That there has to be a release valve if the Federal Reserve cannot increase interest rates, and all they can do to fix any problem is print money. I call it a doom vortex. It's a little hyperbolic, but it just feeds on itself, and the only thing that it produces, the only possible outcome for the eventual end game. Now, whether that's end game is 10 years, 20 years, 10 months, I don't know. But the end game just has to be inflation, potentially hyperinflation.
I would certainly think so. Now, as all these are happening, that means also the dollar is under a great deal of pressure around the world as far as maintaining itself as the world currency. And I know that there are some, for example, you mentioned you were in oil and so forth. I do know that other countries are trying to buy oil for something besides the dollar. Right. And what's going on with that particular situation right now?
Well, that could even go back to 1971. It could even go back a lot further than that. But people, especially Americans, don't realize that. I don't want to get too far in the weeds. I was going to go down the euro dollar path, but I don't want to get too far into the weeds. The way I can explain this in simple terms, there are just as many dollars outside of the United States as there are inside. And the Fed has no idea, nor do they have control over the amount of dollars outside of the United States. You say, well, George, how can that possibly be? The Fed is the only, or the U.S. government is the only people that can issue the U.S. currency. Well, that's not true. And here's how it happens, or here's how it works. You have a dollar account, an account, let's say in Singapore, or let's say China, even better with HSBC, and it's denominated in dollars. Let's say there's $1 billion in that account. Well, that bank can use those reserves, those dollar reserves, to create dollar denominated loans. Okay, so that's how you get all of these dollars. Now, of course, they're electronic dollars, and they're in the form of bank accounts, and they're not in currency in stacks of hundreds, although there are a lot of those outside the U.S. as well. But so you have all of these dollars outside of the United States, to your point. So a lot of those dollars are used to buy oil. A lot of them are used to fund gold mines and certain businesses. And if you look at the funding mechanism outside of the United States, a good majority of that is denominated in dollars. So to your point, if you have, and I want to make one more point, that Jeff Snyder, who understands this stuff better than anyone on the planet. And if you haven't listened to Snyder's stuff, I would strongly suggest doing so. He does a whole series on macro voices. He's with Alhambra. But Jeff gets into the weeds of the euro dollar system. And if this euro dollar system breaks down, or if the petrodollar breaks down, there's all of these currency units outside of the United States. And if you're holding, let's say, $1 million, and you're a Russian, or you're someone in Kuwait, or wherever outside the United States, and you start to see that there's an inflation risk in the United States, meaning that you're rapidly losing purchasing power with your dollars. Okay, what are you going to do with those? You're not going to keep them in your bank account. You're going to get rid of them as fast as you can. So how do you get rid of them? You're either going to put them out onto the market and buy your local currency, or you're going to put them into the United States and inject it into the United States economy by buying, let's call it rental properties or housing or something. So you could have and one more point about Jeff Snyder is he believes the actual reserve currency isn't the dollar, is not the dollar. He believes that the actual world reserve currency is the euro dollar system that I was talking about, how these dollars are created offshore. And if you take that to the next step, well, then if that's the world reserve currency, then that would mean there has to be more dollars outside than there is inside. So let's just say there's $20 trillion worth of M2. Well, that means that there's actually at least 40 trillion of dollars. So when that floods back into the system, what does that do to inflation? How does the Fed stop that? There's no way they can do that. So by us stoking all of these fires around the world through FATCA and all of these other controls that we have, that we try to have on the financial systems of other currencies, we're just poking wasp nests is what we're doing. And eventually these countries like China, and that where their economy is larger than ours, not in aggregate total, but in some ways is larger than ours, they're just not going to take it anymore. And they're like, we are through with the SWIFT system. We're through with FATCA. We're through with the United States being a financial bully, and we're just not going to deal with it anymore. So we are going to start trading trading oil in rubles, or maybe some sort of yuan, or some sort of other currency. Maybe it's SDRs. Maybe that's how it goes. Maybe they have a gold-backed currency. Who knows? But eventually, it's going to move away from the dollar, because if you were one of these countries, you have to put yourself in their position. Would you want to be bullied by some? I mean, let's just take a look at it from the standpoint of the United States and say if Russia, let's say the Russian ruble was the world reserve currency. So every single transaction or every single wire that we had to do, we as an American, we had to send that through Moscow. And Russia said, you know what, United States, we really don't like that drone that you sent into Iran the other day. Yeah, that wasn't too good. We're going to go ahead and put a sanction on you, where we're not going to allow anyone to import wheat or Mercedes or cars or anything of these things into your country. So you're going to have to rely on your own supply chains, basically. Well, then that creates inflation. That creates a world of hurt for the average consumer. And they sit there and it's obvious that that's being done to them by Russia. So if you flip the coin around, you can see that as Americans, we would be like, hell no. We're not, no. We are not going to be bullied by some other country. We need our own way to pay for oil. We need to pay for oil in dollars, not rubles. Well, that's what every single other country across the world is doing right now, looking at the United States.
Right, you brought up the perfect transition here, because you mentioned SWIFT and its particular function within the world banking system, and Ripple, which is under XRP, is part of Ripple in its own way, but Ripple has its on-demand ledger and some of the other systems that it's testing out around the world right now, where you have almost instantaneous changes between currencies, and it can go from a rupee to a dollar, or a dollar to a rupee, and within seconds, because of the way the ledger is built. Do you see that when that, or if that happens, it's an if, there's still a lot of things to go on for that to come to pass. But if you saw that happening, then I would think that we would see really the fiat system or the dollar or whatever becoming much less important, because everybody could trade in their own currencies. Am I off base here, or just correct me if I'm wrong, because I want everybody's opinion on this.
So the way I think about that is I've got to compartmentalize it into what I want to happen and what is most likely going to happen. So as a libertarian and someone that believes in free markets and personal liberty, I look at that and I say, this is amazing. I look at a cryptocurrency or any democratized currency. I think the free market should be able to choose whatever it wants to use as a means to transact and to trade your excess productivity for someone else's excess productivity, whether that's seashells or Bitcoin. I don't care. The free market should decide. And as someone that does a lot of traveling, I think that the functionality of a Bitcoin or a Ripple is just I mean, it's amazing. It's amazing. Right now, do you know what I have to do to get money into Colombia? I mean, it is a pain in the butt. And I have some outstanding relationships with the major bank and brokerage firm here, the fiduciary that I use. So for me, it's a heck of a lot easier than it would be for a normal gringo. But if I was just using some sort of cryptocurrency, it doesn't matter where I am in the world. I wouldn't have to go through all this. So let's say I want to buy a property for whatever, 250 grand US, and I want to bring that money down here and put it into someone else's account. You just got to go through this loophole, this loophole, this loophole. But with a cryptocurrency, it's just seamless. Boom, and it's done. So it's so much more, it's so much more efficient, and it's so much better from the standpoint of privacy and anything that you can take out of the control of central planners and put it in control of the people. I am in favor of 100%. The problem is, I think that the central planners and the people who like being in charge, at some point in time, quite frankly, I don't think they're smart enough to know how this can affect their power on a moving forward basis. But I'm concerned that once they do, they'll try to prevent it from taking over. Whether they will succeed or not, I have no idea. I hope they don't. But that's why any type of cryptocurrency, and I haven't done enough research on each of them to know what I like and what I don't like. But that's why I look at them as a speculation and not as digital gold. And let me be clear. I look at gold as an insurance policy. That's a way to protect my wealth. It's a way to protect my purchasing power, regardless of what happens. I don't look at gold as a way to get rich. I'm not one of those people that says, I think gold is going to 20,000 and now. It may, but that's not why I own gold. I own gold just like I own car insurance. It's just car insurance for my money. And so I want to make sure that people understand that. I look at things two different ways. And a lot of people, I think, conflate gold and cryptocurrency to where they see it as like competing asset classes. And I just don't see that at all. One's a speculation, one's insurance. I look at maybe the junior miners as something that would be a lot more comparable to a cryptocurrency, because that's not insurance. That's more of a speculative play. I don't know if that answers your question or not.
Well, certainly. I know that the banks are going through, just going through hell basically as far as the SWIFT system now, because it's kind of like, as you said, the old technique working, and it's pulled from 40 years ago, 50 years ago, and it's broken down. But whether or not they're going to look to other types of systems that are better served, and also will save the bank a tremendous amount of money, because the transaction fees, the holding fees, the reserve fees, and so forth they have to have in those cross-border transactions. We don't know, however, if it'll ever be adopted. We know there are some big players that are in the planning stages. We know there are some big players that have put out some very interesting documents, but that's just written words right now. There's there's test programs running. For example, MoneyGram is using XRP as its cross-border transactions in 3 different money corridors right now. South America is one of them. I don't know if Colombia's in it, but Venezuela, I believe, is. Mexico is. But it's already being that particular cryptocurrency is already being used in order to facilitate all those transactions that MoneyGram has going on. I know the IMF has got it in their documents. I don't know what they plan to do with it, but who knows? So it's all speculation right now. You're exactly right. When I even myself talk about something like the XRP, because that's what I'm involved in as far as from my side, I still look as a play toward the future, and not I'm sure not going out and selling my house and putting all the money into it. Let's put it that way. But it is an offset for things that I think might be happening in the world that I may certainly be a part of. I look at it as hopefully as leveling the playing field as far as individuals and individuals' money around the world. But again, we don't know, George. We just don't know.
Yeah, I always encourage people to look at history and look at events that have taken place, not just in the United States, but outside of the United States. So I do a lot of consultations. People, they book my time and they want me to help them answer and try to figure out specific questions that they have for their personal situation. But one thing that a lot of people are really worried about is that we'll have this catastrophic event where we're all living in caves and eating canned goods. And now I'm not saying that won't happen. I think it's a possibility. But if you look at the catastrophic type events that are occurring as we speak, in fact, not too far away from me, just right here in Venezuela, look at Zimbabwe, look at any of these countries that have experienced the devastation of hyperinflation, and you look at what those people did and are doing to not only maintain their wealth, but to survive, then you can say, okay, well, if that happens in the United States, let me use that as kind of a playbook on what I might do in order to not only survive, but maintain my purchasing power, just like the people are doing in Venezuela. So then the question becomes, what are they doing in Venezuela to do that? Well, initially, they went in and bought real estate, because in South America, that's like the go-to thing. When the government starts printing money, when you get a whiff of some serious inflation, you buy real estate immediately. Then, of course, then it goes into the stock market. Anything that is a hard asset, it's going to go into. But then once it gets worse and worse and worse, and now it gets so bad where, correct me if I'm wrong, but I think a lot of them are turning to cryptocurrency because that's the only option. That's the only way for them to get money out of the country and out of the reach of the local government who's trying to steal everything that they can get their hands on. So I think my point is that if things were to get really bad in the United States, I actually think that's what it would take in order for the majority of the people, the soccer moms, the dads that are just watching football on Sundays, drinking beer, working 9 to 5, those normal people out there, to get them interested in a cryptocurrency. Unfortunately, and I wish this was not the case, but I think that's what it would take. It would take a serious type of problem in order for them to consider it, because they would have to consider it not because they wanted to, but by necessity.
Well, of course, and very few people, even that I talk with or even mention it to, have any idea what I'm talking about. It's not part of their daily life thinking. But neither what's happening in the repo market or what's happening from the Fed and all the money is going into shore up all the banks in our country and around everywhere, they have no idea of that. It's just not part of their lives, but it's going to affect them one way or the other. It's going to affect them.
Yeah, it is.
But I'm not a conspiracy theorist. I have trusted that there are certainly people smarter than me that will hopefully develop some sort of system that makes sense. Since we're into the first week of 2020. George, what would you say?
I've got time for probably one more. I got to try to get up here at 3:00 to go to another interview if possible, Chris.
Then, all right, then great. We'll make this real brief. Anything you'd like to say to the audience as far as what they should do in 2020 to preserve the money they have?
Yeah, just for the average person out there, the average Joe that I was just talking about, right?
Yes.
The first and foremost, you can make sure that your mortgage is a 30-year fixed rate deal. So if you're worried about inflation, which you should be, then if you have a fixed rate loan or a fixed rate mortgage, if inflation or when inflation exceeds the interest rate on your mortgage, that is a transfer of wealth from the lender to you, the borrower. And and almost everyone has a mortgage. So I think that's something that's applicable to a lot more people. And that's something that they could actually be proactive and do. So I would make sure that my mortgage was a 30-year fixed rate loan. I would make sure that I've got some sort of hedge. Now, whether you think that's gold, whether you're a gold type of person, whether you're a crypto type of person, and I by no means am I saying to take 90% of your wealth and put it into gold. I don't suggest that, but I think it is wise to maybe have 5 or 10% of your investable assets in an insurance policy. Now, whether you think that insurance policy is crypto or gold, that's not up for me to decide. That's up for you to decide. But I think those are the two things that just everyone can do to make sure that they're as safe, or their assets are as safe as possible. And, one more thing. And if you have money in a bank, if you have cash on the sidelines, let's say you're saving money to buy a house, or you're just trying to save money for the future, or you're keeping some powder dry because you think the stock market or the housing market is going to come down and you want to take advantage of that, don't keep your money in a bank. Don't do it. Watch one of my repo videos and remember that if you have your savings in a quote unquote safe CD or money market account, there is a chance that the bank is putting that to work in the FX swap market, which means it's going to Deutsche Bank, or the repo market, which means it could be going to, who knows, pick the usual suspect that you don't want your money being a part of. People just don't realize that if you're getting any more interest than what you would get on a checking or a savings account, they're taking exponentially more risk with your money. So what do you do? Well, people may think I'm crazy and it's counterintuitive, but I actually suggest taking out that cash and just putting it into T-bills. So short term, just 3 month, 6 month, and roll them over, because then your counterparty is the government as opposed to Deutsche Bank or the repo market or the FX swap market or something like that. And although it's not great, of course, I think it's better. And to be clear, I'm not saying take all of your savings and put it into T-bills. I'm only saying for the portion of your portfolio that you want to keep in cash, and that could be 0%. I don't know. But if you're someone that wants to keep a portion of your portfolio in cash, I would strongly suggest considering just 3 month T-bills and rolling them over.
Very good. And I think that's excellent advice when it comes to cash in a bank right now. I know you're up against this hard break, George, and I want to make sure that I don't take advantage of your time any more than I already have today. But I appreciate it. And our audience, I know, is going to love hearing what you have to say on today's episode of XRP Unplugged. Thank you, George. Appreciate you joining us.
Awesome,
have a
Chris.
great day.
Thank you for having me.
Bye-bye. Okay, folks, XRP Unplugged has really enjoyed this one. I know that you out there in our audience are going to have other questions. So I want you to make sure that you look for George Gammon on the YouTube channel. and watch some of his videos. They are fascinating, educational, understandable, and worth every minute of it. So please join him there. And as we close out for today's episode, I'll look forward to seeing you on the xrparmynews.com site. And until the next episode, have a great day. Bye-bye.